Okay, let's dive in. We've got quite a stack of information here, the result of some deep research done using AI tools like Gemini and ChatGPT by investment professionals, including certified financial planners and wealth managers. And it all seems to circle around a vital question, especially if you're thinking about retirement. Or maybe you're already there. How protected is your savings really against the next big market correction? Because we know one's coming eventually, right? It's not if, it's when. So, our mission here in this deep dive is to sift through all this information, pull out the most important insights, and help you get a clearer picture of what's actually going on with risk management today. That question about protection isn't just some abstract idea. No, for anyone over 55, maybe even a bit younger, a significant market drop can have a huge impact. It really can affect your future peace of mind, your financial security.
Absolutely. So we're going to look at what the traditional approaches offer based on this deep research, where they might leave you a bit vulnerable, frankly, and then how artificial intelligence, AI, is starting to, well, change the game in managing investment risk.
Okay, so let's start with those foundations then. The traditional methods that this deep research talks about. The classic approach for decades really has been pie asset allocation. You know the concept? Spread it around. Yes, spread your money across different slices. The deep research notes that traditional methods spread money across various investment categories, like large cap, small cap, international, commodities, and specific sectors like healthcare and consumer discretionary. The thinking is pretty straightforward. Diversify. If one slice shrinks, maybe another holds steady or even grows, balancing things out.
And that's the theory, and look, it often works fine in, let's say, normal market conditions. But what this deep research really emphasizes is the big limitation, especially again for those near or in retirement. During those really serious market downturns, the kind that, really bite, many of those seemingly diverse pie slices, they can actually all go down at the same time.
So much for diversification then.
Well, exactly. It leaves savers exposed right when they can least afford to be.
And that sounds like it connects directly to something else highlighted here. The sequence of returns risk.
Yes, absolutely critical. It's basically the danger of hitting a major market slump, say, right when you retire or very early on.
Because if you're starting to take income out of your portfolio and the market tanks, you're selling assets when they're low, locking in losses.
You're depleting your principal much faster.
So even when the market eventually recovers, you've got less capital left to actually benefit from that recovery. It can wreck your long-term plan.
And time is the crucial factor here for, say, the over 55s. It really is.
I mean, a big drop when you're 60 is a completely different scenario than the same drop when you're 30.
You simply don't have those decades for a full market rebound to fix the damage if you need the money sooner.
It can genuinely shift your whole retirement picture from, comfortable to quite uncertain.
The deep research also mentions the classic buy and hold strategy. Just ride out the storm because markets always come back eventually.
They do. Historically, markets recover.
But the point made here is, can you personally afford to just wait it out?
If you need that money for living expenses, for income, and you're forced to sell when assets are down significantly, well, you're cementing those losses.
Buy and hold works best when you don't need to touch the capital for a long time.
Okay, so understanding those vulnerabilities, especially for people closer to retirement, that's really crucial context.
It is. And that leads us perfectly into why this deep research is introducing artificial intelligence, AI, as a potential, a game changer in how risk is managed now.
Yeah, and what's really fascinating is how the deep research describes AI working in this investment context.
It's not like magic dust. Right, it's not Skynet taking over your portfolio. No, not quite.
It uses very sophisticated algorithms, quantitative models.
Think of it like these incredibly smart systems that are constantly scanning the entire global market. Everything, way beyond what any human team could possibly track manually.
Like having a massive, tireless research department working 24/7.
That's a good way to put it. Exactly, it's analyzing just colossal amounts of data almost instantly.
What kind of data? Oh, company financials, earnings reports, economic indicators, global trends, political news, even subtle things like shifts in market sentiment or, say, the potential impact of new tariffs or regulations. Things that can ripple through the markets. And you said instantly. Is the speed the really key difference here compared to traditional methods?
It's absolutely critical. That's a major point in this deep research. Traditional analysis, portfolio adjustments, they often rely on human review committees meeting. It can take days, sometimes weeks, to actually react to big market shifts. And in today's markets, which can move so fast, those delays can be incredibly costly. The deep research suggests these AI-driven systems can spot risks, identify necessary adjustments, sometimes in seconds, allowing for really rapid response to protect assets before a big drop really takes hold, or at least mitigate the damage much faster.
So, it's not just the speed then, it's also getting past maybe human limitations.
Human advisors, they bring in valuable experience, judgment, understanding of your personal goals that's irreplaceable. But we also have biases, right? We can panic in a downturn or maybe get a little too optimistic, complacent during a long bull run. We get tired, we can miss things. AI doesn't get tired or panic, exactly. It operates purely on computation, evaluation. It processes that huge amount of information without emotion, without bias. It just crunches the numbers relentlessly. And that significantly reduces the potential for, human error or those emotional decisions that can happen during really stressful market times.
So, the human advisor provides the strategy, the AI provides the vigilance.
The AI is vigilant, 24/7, constantly monitoring, reacting based on the data and the preset parameters, protecting your investments even when your advisor is, asleep or on vacation.
Now, I can hear someone listening thinking, okay, but can we really trust machines with our retirement savings? That feels like a big leap.
It's a totally valid question, and the deep research addresses it directly. It's very clear. AI isn't about replacing human advisors. Not at all. Okay, it complements them. Think of it as an incredibly powerful tool for the advisor, enhancing their abilities. It gives them precise real-time insights and capabilities they simply couldn't get otherwise. It allows them to make better, more informed decisions faster.
So the analogy used in the deep research, AI is like a sophisticated radar system for an airplane pilot.
The pilot is still flying the plane. That's your advisor. And it fits pretty well. The AI ensures the pilot, your advisor, has the absolute best, most up-to-the-minute information and tools to navigate safely, especially through turbulence. It can identify risks, maybe even opportunities that the human eye might miss just because of the sheer volume of data. And it can execute protective strategies automatically if certain predefined signals appear in the data.
Okay, let's connect this to the current market context mentioned here. We see markets hitting historic highs.
Yep, been quite a run.
And anyone who's been investing for a while knows markets move in cycles. Peaks are always eventually followed by corrections, pullbacks, sometimes worse. It's inevitable. So the question isn't if a correction happens, but when and how severe it might be, which loops us right back to that crucial point for you listening. When that correction does arrive, is your financial advisor equipped? Do they have these advanced tools, these AI systems ready to react quickly and effectively to protect your specific investments?
And it sounds like the deep research clearly positions advisors who are integrating AI now as having a pretty significant advantage. Oh, absolutely. The argument is that by dramatically cutting down response times, from weeks to seconds, potentially enhancing the accuracy and sheer scope of market analysis, and enabling those dynamic real-time portfolio adjustments, they're just fundamentally better prepared. Better prepared to defend savings against those big, potentially catastrophic losses we've seen in past crises like 08. That's the idea, to potentially sidestep the worst of it, or at least cushion the blow far more effectively than purely traditional methods might allow.
So, this naturally leads to a question for you, the listener, to consider. If your financial advisor isn't actively using AI, or at least talking about how they're leveraging advanced technology for risk management well, maybe it's worth asking why not. Are they using the most modern tools available? Are your savings really prepared for the kind of volatility we see now and might see more of? Is your advisor potentially falling behind the curve? It really boils down to making sure your financial future isn't solely dependent on strategies that were perhaps designed for a different, maybe slower market era. Okay, so let's try and pull together the core findings from all this deep research we've gone through, right? It seems AI is really moving beyond just being some niche concept in investment risk management.
Yeah, it's not sci-fi anymore. For people who are serious about protecting their savings, especially as they get closer to needing that money in retirement, it's looking less like an option and more like a necessary tool. That seems to be the strong message here. Your financial security depends in large part on the quality, the sophistication, and especially the responsiveness of the risk management strategy being applied to your nest egg.
And that leaves us with a final thought drawn from the deep research for you to mull over after this deep dive. Are you more comfortable aligning your savings with risk management methods that are rooted in the past, or are you prepared? Is your strategy prepared for the future of market volatility using tools like AI? Something to think about. How could that choice impact your own financial security down the road?
If you found this overview helpful and want to stay informed about intelligent investing and how technology is shaping your financial future, please consider subscribing to this YouTube channel.